In Chapter 9, we're looking at additional methods or issues involving inventories. Specifically, we're looking at the lower of cost and net realizable value, the gross profit method, and the retail inventory method. So we're going to look at a few exercises here and show you how each of those is used and computed. Exercise 9.1, Merrill Company has 3 products in its ending inventory. Specific per unit data for each of the products are as follows. Cost is 40 for product 1, selling price is 80, costs to sell it are 12. The product 2 and product 3 information is listed. What unit values should Merrill use for each of its products when applying the lower of cost and net realizable value rule to ending inventory? For product 1, the cost is listed. We then compare that to net realizable value. Net realizable value being selling price minus costs to sell. So 68 for product 1, 80 minus 12. $16 for product 2, that should be 24 minus 8, 24 minus 8. And then 120 or 140 minus 20 for product 3. So the inventory value, the lower would be the $40 for product 1, 16 for product 2, and 100 for product 3. So the true value of the inventory at the end of the year should be those inventory value amounts. In exercise 9.8, we're looking at the gross profit method. August 29th, year 1, a flood destroyed the entire merchandise inventory on hand in a warehouse owned by Flash Sports Company. They have some information available regarding their inventory system before the fire. What we need to do is estimate the cost of what was destroyed in the flood using another method. And so lower cost or net realizable value is something you do at the end of each year when you're getting ready to report inventory on the balance sheet. It's required. This method you use really in estimating your inventory for something like this. So when you have certain information, such as the beginning inventory and what it cost, $35,000, and all the purchases for their cost from beginning of the year through the date of the event, you can then determine everything you could have sold. $125,000 of goods that cost $125,000. The sales on those goods from the beginning of the year through August 29th are $150,000. The gross profit made on those sales is 25%, or $37,500. So, if the sales are $150,000 and your profit left over after subtracting cost of goods sold is $37,500, the cost of goods that were sold, $112,500. So the cost of everything you could have sold was $125,000. Based on what you sold and the typical gross profit you make, you've estimated that you've sold goods that cost you $112,500. So the difference is the cost of the inventory that was destroyed, $12,500. Again, this is all estimating, and it's not an official method to be used to create financial statements. It's mainly used to do estimating of inventory. In exercise 9.9, November 21st, year 1, a fire at Mindo Company's warehouse caused severe damage to its entire inventory. Mindo estimates that all usable damaged goods can be sold for $13,400. The following information was available from their records. Based on recent history, gross profit ratio for their sales is 31%. calculate estimated loss on the inventory from the fire. So now it's the same method. We're just throwing one or two things in the mix. So let's see. We start with the inventory, or I'm sorry, we'll start with sales. Sales for the period were $246,400. The gross profit is 31% of net sales. So cost of goods sold is generally 69% of sales. The beginning inventory is $112,000. Purchases were $156,800. So the cost of everything that could have been sold, $268,800. According to our information above, the cost of goods sold was $170,16. So the ending inventory was estimated at $98,784. But that's how much total inventory there was. It wasn't all destroyed by fire, because Mindo estimates that all usable damaged goods can be sold for $13,440. So the usable goods, $13,440, loss from the fire, $85,344. So subtract those items that can be sold at what they could be sold at. So we saw lower of cost or net realizable value, and we saw gross profit method. Now we're going to move to the retail method. So who uses this method? It's a method of estimating inventory used by retailers. You have to keep track of a couple key items when you're using the retail method: the cost of the goods and the retail value of the goods. Now, here we have Jim Ardonia General Store uses a periodic inventory system and the retail inventory method to estimate their ending inventory and cost of goods sold. This information is available for the month of October. Beginning inventory cost $36,000. They could sell that inventory $51,429. They purchased $18,620. That's the cost. They could sell those purchases $32,503. Now, the next item, net markups, is the total amount the price went up from the original retail value. So at some points during the year, a retailer may raise the original sale price, retail price. Well, they kept track of those and they total $1,234. They may also mark certain items down below their original retail price. Those are called markdowns. And then there's net sales. So let's see how we handle these. First of all, we start with beginning inventory at cost and retail. We then add our purchases at cost and retail. We then add net markups at the retail amount and net markdowns at the retail amount. We subtract those markdowns. So what we're saying here is all the goods we could have sold cost us $54,620, and from marking up and marking down, we would have sold them for $84,343. What were our net sales? $32,915. Subtract them from the retail value. So right now we have an inventory value at retail, what it could have sold for. We know what some of the sales were. So the ending inventory at its retail value is $41,428. What we have to do is convert that back to cost. And under this method, we would take the total cost of goods available of $54,620 and divide it by the retail of goods available for sale of $84,383. and that is our cost to retail percentage. So what this is saying is cost is 65.48% of retail. So all you need to do to determine ending inventory is multiply your ending retail inventory value by 65.48%. So the ending inventory at cost, this is just an estimate, $33,428. If you subtract $33,428 from $54,620, that's your cost of goods sold, $21,192. The cost of the net sales is the same as the cost of goods sold. Let's look at the retail method again. Now, instead of the method we just used, which is just a straightforward, here's how we do it method, this company determines their inventory at the inventory that approximates average cost, lower of cost, and net realizable value. Retail inventory method. And we're going to do a couple of these. All of the retail methods, your setup is the same. Your table is the same. It's just that your cost to retail percentage will be calculated differently. So under the last method, we added in markups, we subtracted markdowns, and we determined our percentage, total cost of goods available divided by retail value of all goods available. Now, let's see how we compute retail method approximates average cost, lower of cost, and net realizable value method. Start with beginning inventory at cost and retail, 200 and 320. Add your purchases. Cost of them are 700. They could have been sold for 870,000. Add freight in. Freight in is a cost of inventory. It has no retail value. Markups increase retail value where markdowns decrease retail value. But under this method, we stop right there. Sorry. I'm just going over it. Okay. And before we subtract markdowns, we get a total in our retail column. We then subtract markdowns. So our goods available for sale would be $912,000 in the cost, and then after we subtract markdowns, $1,212,000. That's how much we could have sold those goods we paid $912,000 for. The actual net sales are $900,000. Subtract them. So your estimated ending inventory retail. So of that $1,212,000 you could have sold everything for, you actually sold $900,000. So you have $312,000 retail inventory. But we don't report inventory at what we could sell it at. We report it at what it originally cost us. So we need to multiply it by some cost to retail ratio. The way we determine our cost to retail ratio is different. Under this method, you take your cost of goods available for sale, the cost column, 912, and divide it by your retail inventory total before subtracting markdowns. So you will divide it by the 1,218,000. So 75% is the percentage you use for your cost to retail percentage. So it's saying 75% of the retail value is how much your inventory costs. So ending inventory would be 75% of 312,000. Cost of goods sold would be 75% of. Sorry, I know it's skipped over, but take a look at that again and make sure you understand that. We're going to go on to a different method. Hybrid owns a chain of hardware stores throughout the state. The company uses periodic and retail inventory method to estimate ending inventory and cost of goods sold. Here's their information through the first 3 months of the year. They estimate LIFO, cost of ending inventory and goods sold, using the retail method. So now this is LIFO retail method. So we saw normal, or whatever, just retail method. Then we saw average cost, lower of cost or net realizable value. And now we're seeing LIFO retail method. So we're going to start with our beginning inventory at cost and retail again. We then show our purchases, cost and retail. If there was freight in, we would add that at this point to the cost, but there isn't. We're going to add our net markups on the retail side, because that's the side that you would increase the retail value from what you originally said you could sell it at. Then you would subtract your markdowns from its original sales price. So everything that could be sold, not including beginning inventory. So really it's just the purchases, I should say, for the year, total $729,312, and the retail value of only the items purchased during the year, or the first 3 months, $1,027,200. Overall, the cost of everything that could have been sold, beginning inventory plus the goods that were just purchased during the year, $921,312. The retail value of those items, the $336,000 plus the $1,027,200, $1,363,200. So if they sold all of their inventory, that would be their sale price, and the cost of goods sold would be $921,312. But they didn't. Now, what we do when it comes to LIFO is we first determine a beginning inventory cost to retail percentage. And that's only based on the cost of beginning inventory divided by the retail value of ending inventory, or beginning inventory, 57.1429%. We also find a cost to retail percentage on the purchases for this year. Purchases were $729,312 cost divided by retail value of only the purchases, 71%. We subtract our net sales from the retail side, $960,000. That's given. So what's left? Estimated ending inventory at retail, $403,200. Now we've got to convert that $403,200 to cost. Now remember what LIFO stands for. Last items in are the first ones out. So what's left in ending inventory? Well, definitely the beginning inventory. So how much at retail can we find of that ending inventory back up in the beginning inventory? $336,000. Well, that $336,000 has a cost of $192. Okay, you could go and do the multiplication for it, but that's the cost. All $336,000 is still considered an ending inventory because the oldest stuff is still an inventory when it comes to the LIFO method. The $67,200 remaining amount at retail has to be converted to cost at the purchase cost to retail percentage of 71%. So the cost of the $336,000 is $192. The remaining $67,200 in retail ending inventory is cost at 71%, or $47,712. So ending inventory would be $239,712 under this method. Meaning cost of goods sold would be $921,312 minus $239,712, $681,600. Different approach because we're assuming last in, first out. So all these purchases that were made, or a lot of them during the year, would have been removed under LIFO, or they should be removed. So we start when we're determining the cost of inventory, ending inventory, we assume if our retail inventory amount that we calculate, the 403,200, if the beginning inventory retail amount is that or lower, that's all still there. So the cost of that would be the 192. We would just add the additional amount from this year's purchases at that cost to retail percentage. So a couple different ways so far. In exercise 917, Augustine Department Store uses the retail inventory method to estimate ending inventory. The following data pertains to one of its largest departments for the month of 2016. So we're going to compute the ending inventory, and cost of goods sold applying the conventional retail method. And then we'll recompute the cost to retail percentage using the average cost method. There's a lot more stuff in this now. Let's take a look. Beginning inventory, you would start with the cost and the retail. We know that already. We would add the purchases at cost and retail, add the freight in at cost, subtract any purchase returns that are not subtracted already out of the purchases at cost and retail. Add your markups to retail. Subtract your markdowns. I'm just going to keep going with that. Everything that could have been sold at this point. $279,187 is the cost. $426,319 is the retail. Now, normal breakage, that would be subtracted out of retail because it would not be available to be sold. Subtracted out of retail. Subtract out the sales plus the employee discounts. Employee discounts would have been subtracted from the original sale amount. We want to know the true amount or retail value of what was sold. So if you add the sales and employees discounts together and subtract that total, you're subtracting the true retail value of the sale. So the ending inventory after subtracting those items, 150,851. Now we've got to convert that ending inventory that's at retail amount right now to cost. The conventional retail method is the method where you take your cost of goods available, $279,187, and divide it by your retail value before markdowns, $429,519. So the value would be 65% of $158,51 or $98,053. That means the cost of goods sold, $181,134. Cost of everything that could have been sold is $279,187. What's still here? $98,053. You subtract that. The cost of everything that was sold, $181,134. Now what they want us to do in requirement 2 is the same thing, but now use the average cost method. So now you take the $279,187 and divide it by the $426,319, the retail value of the goods after net markdowns. And that will give you the 65.48%. Multiply that by your ending inventory value at retail, you'll get $98,053 as the cost. So it's set up the same way. It's just the way you determine the percentage to convert your ending inventory from its retail amount back to cost is just different depending on the method. Exercise 919, our final one. Well, if they can't get any more complex, now we're going to do one assuming dollar value LIFO. Remember dollar value LIFO from last chapter? So here's some data, and they give us a retail price index for the first year. Let's take that information and calculate the retail method using dollar value LIFO. First of all, beginning inventory is at 100%. 77,140 is the cost. Retail is 133,000. The next area are your purchases, markups, markdowns, net sales, and then the retail price index. So base year at cost over base year at retail, 58%. Year one at cost, 111,760. Year one at retail. So you're going to take your 259 plus 6,000 minus 11,000. 254. Cost to retail percentage, 44%. So that's your first step. Determine your cost to retail method using for beginning inventory and purchases, because it's LIFO. You still want to do that just like we did, but this is dollar value LIFO, so of course we'll have some additional steps. Now let's go to our setup. We're going to take beginning inventory at both cost and retail, add purchases at cost and retail, add net markups to retail, because that's what gets marked up, the original retail of the purchases, and then subtract markdowns. So of everything we could have sold, cost was $188,900, could have been sold for $387,000. The actual net sales, $235,639. So ending inventory, $151,361 at retail. So that's all pretty straightforward. What's next? Well, first we want to know ending inventory at year-end retail prices, $151,361. Now we're going to convert that to ending inventory at base year retail prices. We'll use the 1.04 retail price index. So we'll divide the 151,361 by 1.04. So if these goods were sold as of the beginning of the year, or the beginning of time 100, they would have sold for $145,539. So let's see what kind of inventory layers there will be. The first 133,000 of retail value is at base year price, because that's beginning inventory 133,000. The remaining 12,000 is a new layer that was added this year. So that will total then the total 145,539. We've accounted for that. Now let's convert those to cost. Well, the 133, you multiply that by 1 and then 58%. 133, 1 is the base year, times 58%. Cost is 58% of retail in the beginning inventory, 77,140. Take the 12,539, multiply it by 1.04, the new layer added this year. Now convert that retail amount back to cost at 44%. The purchases cost to retail conversion amount. So what's the cost of the ending inventory? $82,878. So a little bit more steps, a few more because of the dollar value LIFO item, but take it step by step. So ending inventory, $82,878, cost of goods sold, $106,022. I believe that's our last one. So any kind of questions, post to the discussion board.